Financial history is littered with examples of speculative bubbles that eventually burst, from Tulip Mania in the 1630s to the dot-com bubble in the late 1990s. There are several reasons why such bubbles develop. One of them is the power of storytelling.
Every time we look back at a historical kind of bubble episode, we often have a narrative associated with it. It tells a story that has much more contents to it, has much more, there is a logic, there is what memory psychologists will call so many cues. It's not just about the number, it's also about, when the market was doing like this, how did people feel? What was, the market? What were the analysts were saying? All of these things, it's just much more concrete. And I think that makes the entire thing much more believable, if you know what I mean. It's not just about just the cold numbers, but now you're almost like in a story. And I think that, really get people to believe in what they want to believe.
Another common feature of speculative bubbles is what behavioral experts like Peng refer to as herding behavior. In other words, investors blindly follow other investors, assuming, often wrongly, that those investors have done their research and know what they're doing.
What happens in the herding behavior is that I don't really necessarily have anything, concrete about a particular asset or particular stock. I don't really know what is, the value of a tulip or bulb, or I don't really know the value of Microsoft during the internet bubble. But then, my friend bought it and got a good return out of it, and I got to know about it. And then for me, it was like, okay, maybe I don't know anything about it, but apparently my friend did. And then I'm just gonna repeat what this person does. And then once that kind of gets aggregated, and a lot of people started doing that, that really gets people to herd. And I think this is what basically happens, is that one person's opinion gets magnified and gets repeated by many others.
Many investors enjoy the excitement of speculating on a particular investment, but a far more sensible strategy is to have a diversified portfolio and stick to it.
There is a bit of a disconnect. We have all of these insights about how, what people should be doing, but they are not really taken by a lot of, people who actually make decisions. We have to take, these things that we found about how investors trade more seriously and better connect with, the finance media about how things are done. I'm basically putting all of my money in extremely diversified funds that are everything. So I think when I was a PhD student, that was having fun with stock trading, but now I'm doing extremely passive investment. And I think that's done reasonably okay for me. I study behavioral finance, but I think in my own portfolio decisions, I'm extremely rational.
So beware of investing in something just because others are. And remember, that's their choice. It's much better to focus on playing your own game than trying to beat others at theirs.